Two cheap stocks to buy near their 52 weeks lows. I have some very interesting ideas for today's videos. The last one was a success. I talked about a company trading at 7 times earnings. It was Bristol Myers. Since I did the video, Bristol Myers has done extremely well. I have another one for today's video. It's a cheap stock. It's trading at 8 times earnings. It's very similar to Bristol Myers. It's going to be the second one. The first one is a popular stock, you could say, but it's trading at 15 times earnings. And I don't think it should be trading at 15 times earnings. So I really hope you enjoy it as always. And the first one is Adobe. Adobe is down 29% over the last 5 years. And it's been going down a lot recently, so much that the stock is trading at about 15 times earnings. It was trading at 45 times not long ago, and now it's trading at 15 times earnings. And I've been saying it for a while, I'm going to say it again. But based on the recent price action of Adobe, of CRM, of a lot of those software stocks that went down because of the AI fears, I'm seeing a lot of strength. On a lot of red days where Nvidia is red and a lot of stocks are red, but Adobe is going green. And that's telling me that maybe the sellers are exhausted, maybe, it's getting closer to the end. But Adobe is a great company and it's going down due to the AI narrative. And they said that it's being disrupted and it's pretty much dying out. Now, if a company is dying out or is really getting disrupted, the first thing that you're gonna notice is a decline in their quarterly revenue growth. It would start to decelerate in a major way, like Walgreens and like many different stocks before they went down in a major way. Now, if you look at the chart of Adobe, you would believe that this is what's happening. But if you pay attention to the quarterly numbers, I'm not seeing any deceleration in revenue growth. The company is still growing 10%. It has been growing 10%. Since December of 2022, AI has been here all along. Yeah, people are still using Adobe, and Adobe is still growing 10.7% in their quarterly revenues. The second sign you could notice with a company that's being disrupted is a margin compression. Because it's getting so much disruption, because there's so much competition, they would have to increase their advertising spend to advertise the product because no one wants the product and they're going to have to discount it, which ultimately shrinks their margins. But with Adobe, we're not seeing signs of shrinking margins. In fact, their margins have somewhat expanded. They're around 36%. They were at 33% back in 2022. And the margins here have been very consistent on an operating margins basis. So if you look at those two metrics, which are very important, I am not seeing signs that Adobe is being disrupted by AI. In fact, I'm seeing the exact opposite, where the company is actually making money and is monetizing AI in a major way. And it says that AI influenced ARR has now exceeded 1/3 of the overall business. So again, I'm not seeing Adobe being disrupted by AI. If you look at the monthly active Acrobat Plus users, they reached 750 million people, over 20% growth year on year. Absolutely amazing. We look at their Firefly, which is mainly one of their AI, 100% AI rated product. Well, it's growing 35% year over year to over 70 million monthly active users. I'm not seeing a company that's being disrupted by AI. I'm seeing a narrative that has taken over the stock, and the company was, again, it was overvalued. I always said it was overvalued before. I called it a bubble, but at 15 times, it's really hard to claim that Adobe is overvalued. And you have a rare mixture of a low valuation, bad sentiment, and great fundamentals with a company that's growing and not actually declining. So the setup here is looking very interesting. Now, for my upside potential on Adobe, the company has grown 14% earnings per share, has grown 13% this year, expected to grow 12% over the next 2 years. So 12 to 13% average earnings per share growth. And this is what I put in over here, 12% for the next 5 years. I put in a trailing PE of 17 because the trailing it's 17. And I put in the same PE for 2030, assuming no multiple expansion, no multiple contraction. I would get about 78% on the upside, or about a 12.2% annual return on Adobe if I'm buying Adobe today. If I want to double my money in this case, I would have to pay about $314 for Adobe. But I'm being honest with you guys, I believe 15 and 17 times earnings, that's like my worst case scenario. It's my less than my base case. My base case for Adobe, it would be 20, 22 times earnings, at least in my opinion. And if we get 20 times earnings, then this is more than 100% from today's price, or about 16% annual return for the next 5 years. So for me, Adobe is looking very interesting with bad sentiment, good fundamentals, and a story that has yet to materialize. It has not materialized yet. And quarter after quarter, people say this is it. This is when Adobe is going to decline. And none of that is happening. The stock is declining, but the fundamentals themselves, they couldn't be better with Adobe. Now, the second one, which is a cheap stock that I haven't talked about in a while, is Pfizer. Pfizer is down 32% over the last 5 years. It's been an absolute disaster. And if you compare Pfizer to NVO and Eli Lilly, Eli Lilly is up 538%, NVO 47%, and Pfizer is down 32% over the last 5 years. And you could say that Pfizer is a cheap company. It's trading at 8 times earnings, 8.5 times, which sounds cheap, but they have pretty much missed out on the weight loss story. Weight loss has been huge. Over the last 4 to 5 years, Ozempic, Wegovy, Zepbound, and a lot of those injections, and they made a lot of money from them, and Pfizer was left behind. They initially had like a clinical trial, and they had a fatal injury. I believe even someone unfortunately passed away, I believe, due to the Pfizer trial, and they discontinued it. So now they're FOMOing on weight loss, which is why they made a $10 billion acquisition of a company called Metsera. NVO wanted to acquire it, but NVO did not want to pay up. So Pfizer paid up $10 billion for this company that's called Metsera. Now, the bad thing about Metsera is that 2 months ago, it was valued at $3 billion. So Pfizer right now is paying more than 3 times the price that it was trading at 3 months ago. It's the same company, everything is still the same. But instead of buying it for $3 billion 2 months ago or 10 weeks ago, they paid $10 billion for this company, which sounds a little bit ridiculous. And the worst part about it is that this company doesn't have a single product on the market, no revenue ever. Not a single product, zero revenue. It's still in its early stage clinical trials. And I'm not sure if $10 billion is a fair price for a company in such an early stage that could be a success and it could not be a success. But I believe the CEO of Pfizer, he's very experienced and he knows what he's doing. And we'll see what happens from the acquisition. But I think the sentiment is that Pfizer has massively overpaid for this company with $10 billion. Now, this company has something a little bit special where they have an 8% body weight loss in terms of a weight over a 5-week trial, and it's only once monthly. So you don't have to inject yourself every week or every 5 days or 7 days or even every 10 days. You just do it once a month. And so far, it's 8% of the body weight. Now, NVO and Lilly, it's once a week, and it's, I believe, 15 or 17% of the body weight. So that's something. It's something different. It's something special. It's something that Lilly doesn't have. It's something that NVO doesn't have. So if that ends up being a success, I could see it becoming very popular where people don't want to inject themselves every week and they could just do it once a month. That's much easier than oral pills. It's much easier than taking other things once a month, and that's it. That sounds really good to me, but I'm not sure if it's worth paying up $10 billion. Now, Pfizer is FOMOing further, I would say, on the whole weight loss category, and they signed a deal for $2.1 billion. It's like a licensing deal with a company from China. It's called Yao Pharma, which is developing some kind of an obesity pill to, again, compete on the obesity pill of NVO, which just came out recently, and Lilly's pill, which is going to come out, I believe, in May or June. It's expected to come out. Now, Pfizer is not paying up too much right now. They're paying $150 million upfront, and the rest of the $1.9 billion, they are pretty much based on milestone payments, and they pay royalties if it gets approved and if it becomes a success. But the company is definitely FOMOing. Also, I kind of believe they're doing the right thing in terms of catching up on the weight loss story, which is a massive tailwind and a massive trend overall. But I believe they kind of overpaid and they made a lot of mistakes, and that's why the stock is trading where it's trading at the moment. Now, Pfizer also has a lot of headwinds over the next few years, and it's a lot of patent expirations. Normally, this is the best time to be buying those stocks because the market can't really look beyond the patent expirations, and the company is doing a lot of things to grow out of the patent expiring, and they're gonna pretty much be flattening out in revenues over the next 2 years. Now, most of them expire between 2026 and 2028 for a total impact of $17 billion to Pfizer's revenues. This is really, really bad, which is why the company has lowered their guidance for 2026 as expected to be less than what they made in 2025. And they claim that it was due to COVID and other kind of things. And if you exclude COVID, they're going to grow 4%. I don't know why we should exclude it. I believe we should include everything, and Pfizer is going to be making less money in 2026 versus 2025. Now, something that's been waiting on the stock for the last 2 years, and it looks like it's going to continue in 2026, but it could get better in the second half of 2026, is share buybacks or share repurchases. I've seen many stocks like Pfizer, British American Tobacco, which I used to own, and a lot of those stocks, they go down a lot once the company stops buying back the stock, because there's not many interested buyers, and the company has a dividend yield, but they still have a lot of free cash flow that left and no growth. So a lot of management teams and a lot of people, they would prefer Pfizer to do buybacks and to do other things, and that would help the stock price. But that has not been the case, and the company has been focused on paying down the debt, and the company has massive, massive debt, and it had much more debt before, but they had to pay a lot of it off. They still have $6 billion, which was due in 2026. I believe they paid this one off. This is a little bit outdated. $980 million for 2027, $5.6 billion for 2028. So the total debt is like $57 billion. But after they paid the 2026 and they're gonna pay some of the 2027, the company is not gonna have much left in terms of debt to pay, as they will likely start to do buybacks, which I believe the stock will ultimately bottom on a buyback program, and it could happen at any point in 2026 or in early 2027. Now, the company does pay a good dividend. The dividend is about 6.8%, which is really nice, and it also has a lot of debt. So the question is, can they actually afford to pay the debt while maintaining the dividend? And I've said it before, and I said that yes, they could. And a lot of people told me Pfizer is going to cut the dividend. And I said they're not going to cut the dividend. And you could look at the financials and easily determine that. The company is making $18.5 billion in free cash flow. They're paying $9.7 billion in dividends. They still have about $9 billion left in free cash flow for them to pay the debt. And the company doesn't have any except 2036 or 2040, they have 9.4. But now they have 5.6 billion due, 1.7, 5.2. The company can easily manage those with $9 billion of free cash flow left after paying the dividend. So I don't believe the dividend is going anywhere, and I believe the dividend in general is safe. And the company is expected to expand free cash flow in such a major way, and they have done so actually, mainly due to a lot of the cost savings, where Pfizer is going to save $7.5 billion of $7.2 billion in total expenses, which is going to be amazing. And there was a lot of waste within the company, and that's making itself in the free cash flow, which is really amazing from the company. But over the next 2 to 3 years, they have a lot of patents expiring, and the company is not expected to grow in free cash flow or to grow in revenues at all. So if I want to value Pfizer, I would mainly value it on a free cash flow yield basis, and the free cash flow is about 13%. If I'm buying Pfizer today, I will likely get something close to the 13% free cash flow yield, but I also have the call option of a multiple expansion, as the average free cash flow yield for Pfizer was 8.5%. And at 13% free cash flow yield, that looks like a good setup where you could potentially make 12 to 13%, or at least 7% a year from the dividend alone. And then you have the potential of a multiple expansion, especially if the Fed is lowering rates next year. That's going to make the dividend of Pfizer much more attractive to a lot of people that are looking for a higher yield. So I could easily see a multiple reversion back to 8 or 9%, and that's massive upside, up to 50, 70% upside. That's what pretty much happening to Bristol Myers. And I think it could potentially happen to Pfizer once we get a little bit more clarity after Q1, and especially if the company reintroduces their buyback program. I think it could really be huge. Now, between those two, I would of course prefer to buy Adobe, but I think Pfizer is looking really, really interesting, and I wanted to talk about it. And that was my opinion for today. It was not financial advice, so I hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.